All right, let's talk about one of the most powerful and maybe misunderstood concepts in all of finance, derivatives. These are the tools that can manage risk on a global scale, or, as we've seen, create it. They can seem impossibly complicated, but stick with me and I promise you'll get how they work, from the simple idea of a futures contract all the way to the mind-boggling world of financial swaps.
So here's how we're going to break it all down. First, we'll look at the fundamental problem that derivatives were invented to solve. Then we'll get into the nitty-gritty of forwards and futures. After that, we'll explore the incredible flexibility of options, then dive headfirst into the very abstract world of swaps. And finally, we'll connect it all to the real world by looking at the 2008 financial crisis and the rules that came out of it.
Okay, so first things first. Why do these things even exist? Well, it all boils down to a single huge problem that literally everyone in business or finance faces. Nobody knows what's going to happen in the future. I mean, just think about it. If you're running a business or managing money, these questions are everything. What are interest rates going to do next month? Will the value of the euro wipe out my profits on that deal? Is the stock market about to tank? It's this constant, nagging uncertainty that created the need for the tools we're about to unpack.
And right here, this is the answer. This is where derivative securities come into the picture. Now, the name itself is actually a huge clue. Their value is derived from something else, some other underlying asset, like a stock or a currency. At their heart, they're just tools, really sophisticated tools, designed to let you control or transfer or even bet on that risk.
So let's start with the most straightforward way to deal with future prices. You just make a contract today that locks in a price for a deal that's going to happen later. And the simplest version of this is called a forward contract. Honestly, the best way to picture it is as a custom private handshake deal. It's just two people, or two companies, agreeing on a price, an amount, and a date for something down the road. It's totally private, and it's built specifically for their needs. Here's a perfect real-world example. Let's say you're a U.S. corn exporter, and you just sold a huge shipment to a buyer in Britain. You're going to get paid in British pounds, but not for another 90 days. Well, who knows what the exchange rate will be then? That's a massive risk. So to get rid of it, you can make a forward contract with a bank to swap those future pounds for a specific dollar amount that you agree on today. And just like that, your currency risk is totally gone.
But, that private deal has its limits. What if the other person backs out? What if you need to get out of the deal early? That's where futures contracts come in. A future is basically the same idea as a forward, but it's standardized and it's traded on a public exchange. Think of it as the publicly traded, safer version of that private handshake.
And this table really nails the differences. Forwards are over-the-counter, which is just a fancy way of saying they're private. They're customized, which is great, but that also means you have a high counterparty risk, basically the risk that the other guy won't pay up. Futures, on the other hand, are traded on an exchange with standardized terms. And here's the magic trick. A clearinghouse steps in the middle and guarantees every single trade. Plus, and this is huge, futures are marked to market every single day. That just means your profits and losses are settled daily, so you never have these giant, risky debts piling up.
This has all changed so much over the years. If you've ever seen the movie Trading Places, you've seen those insane trading pits with people yelling and screaming and waving their hands around. Well, that whole world is pretty much gone. Today, it's almost all done silently on electronic trading platforms that run pretty much around the clock. So how would you actually use one of these? Well, here's a classic example of what's called hedging. Say a portfolio manager has a $30 million stock portfolio and she's getting nervous that the market might be heading for a fall. To protect herself, she can sell S&P 500 futures short, which is basically a bet that the market will go down. So what happens? The market does fall by 2%. Her stock portfolio loses $600,000, but her short futures position gains $600,000. The loss is perfectly canceled out. It's like she bought insurance for her portfolio. Now, futures and forwards create an obligation. You have to buy or sell. But what if you don't want an obligation? What if you just want the choice to do something without being locked in? Well, that brings us to our next tool, options.
And the key word, the whole ball game, is right there in the definition. When you buy an option, you are buying the right to do something, but you absolutely do not have the obligation. The person who sold you the option, they're on the hook. They have to follow through if you decide to use your right, but you have the choice. And they come in two basic flavors. A call option gives you the right to buy something at a set price. So you'd buy a call if you think the price is going to go up.
A put option gives you the right to sell something at a set price, and you'd buy a put if you think the price is going to go down. It's that simple, really.
Now, of course, a powerful right like that isn't free. The price you pay to buy an option is called the premium. And the best way to think about it is exactly like an insurance premium. You're paying a small, known cost up front to protect yourself from a potentially huge negative event down the road.
Okay, now we're heading into the deep end. We're going to talk about the biggest, most abstract part of the derivatives world, swaps. With swaps, get this, we're not even really talking about buying or selling assets anymore. We're talking about just trading payment streams. So here's the deal with a swap. Two parties just agree to exchange streams of payments. These payments get calculated based on something called a notional principal amount, say $50 million. But here's the really weird part. That $50 million is completely imaginary. It never changes hands. It's just a reference number they use to figure out the actual interest payments that they do exchange.
This diagram shows a classic example. You've got a commercial bank. Most of its loans are at a variable rate, but it's funded itself with fixed-rate deposits. It's a mismatch. Then you have a savings bank with the exact opposite problem. So what do? They swap. The commercial bank agrees to pay the savings bank a variable rate, and the savings bank pays the commercial bank a fixed rate. Boom! Both of them have just completely eliminated their interest rate risk.
And the sheer size of this market, it's just staggering. By the end of 2008, the notional value, remember that's the imaginary principal, was estimated to be over $600 trillion. To give you some context, that is about 10 times the economic output of the entire planet at the time. It's just a mind-boggling number.
Now, a market that huge, operating mostly in private, behind closed doors, well, it's going to have some serious real-world consequences. And that became terrifyingly obvious to everyone during the 2008 global financial crisis.
One specific type of swap was right at the heart of the whole meltdown, the credit default swap, or CDS. A CDS is basically an insurance policy against the loan going bad, but the market for them was a total Wild West, completely unregulated. Nobody really knew who was on the hook for what. So when the U.S. housing market started to crumble, this tangled, invisible web of risk just started to snap, dragging the whole global financial system down with it.
The 2008 crisis was a gigantic wake-up call. It led directly to the Dodd-Frank Act in 2010, which was this massive overhaul of financial rules. And a huge piece of that law was designed to do one thing: drag the secretive, over-the-counter swaps market out of the shadows and into the sunlight.
And the goal of these changes was pretty simple, really. Make the swaps market look and act a lot more like the futures market. That meant forcing trades through central clearinghouses to kill that counterparty risk, requiring trades to happen on public exchanges, making firms post collateral or margin to cover their bets, and just generally making the whole system more transparent and stable. It was a complete redesign.
Which brings us right back to the central dilemma of these incredible tools. Derivatives can be used to brilliantly manage risk, or they can be used to create and hide it on a catastrophic level. The big reforms after the crisis were all about tipping that balance towards safety. But in a financial world that never stops changing, the question of whether it's truly enough, well, that debate is far from over. It's something we all need to keep asking.